Good afternoon, Matt. How you
Hey,
doing, bud?
how are you, Ken?
I'm doing terrific. Doing really good.
Great, great. Well, today is the day before Halloween.
Mhm.
And when we think about today's election or what's coming up on Tuesday, right? It's the week
What's
before the election.
spookier than this?
Right? So, but I'll turn it over to you for the intro and we'll jump into it.
Perfect. Well, thank you, Matt. Yeah, we are all gathered here. It is that time of not the year, but I guess the cycle that we go through. Every 2 years, there's midterms. Every 4 years, there's the presidential election, and every time it's what does this mean? What show me the tea leaves, show me, how the birds are sitting on the perch. There has to be an answer of what this means. And we're going to be talking about that. We have this conversation for a lot of you that are on the call. This is your third, maybe even your, I guess, yeah, it'd be your third presidential election that some of you have been on with us, and we're used to it. But still, it is worth refreshing. Just like you change your oil every now and again, it's always worth reviewing kind of what we're going on. Um, but yeah, Matt, why don't we go to the next slide? And floor is yours.
All right. So those of you who know me know I'm a history guy. And some people said, "Oh my gosh, what are you guys going to talk about?" Without making other people, without upsetting some people on a webinar about politics. Especially with the way everybody is today. We're just going to talk about two things. One is American politics have always been turbulent to the point where even George Washington, who was the first president, said in his farewell address, we've got to watch out for the rise of political parties, right? So, even back in those days, right, politics were extremely contentious. And of course, they were never more contentious than they were during Abraham Lincoln's presidency. I mean, we actually fought a war over politics. And the first line of his inaugural address, "We are enemies, not friends," or we are not enemies, but friends. Um, I think really says it all. We're all Americans. And, for those of you like me who are veterans and stuff like that, when you served overseas, they didn't say, "Hey, Matt, you're from Texas or you're from Minnesota or you're a Republican or you're a Democrat or anything." They just called you either an American or a Yankee. And that was it. And there was nothing, they didn't care, right? They just saw you as an American. Well, we're all Americans, right? We're all in this together. The election's going to happen next week, and then we'll see what happens after that, right? But if history is any guide, right? Is it contentious? Yes. Has it always been contentious? Yes, it has. So what we're going to talk about today is not necessarily, who to vote for or who's better than the other. It's what does all this mean in terms of your plan? So Ken, you want to take it from here and just talk about, hey,
Yeah,
this is how it all kind of pieces together.
you got it. So what we're going to be starting with is brief introduction to myself and Matt. Some of you might be meeting me for the first time. Some of you have known me for a decade plus, but you might be meeting Matt for the first time, but also two of our esteemed guests, Mr. Benjamin Smith and Alan Zhang. We're going to start with introductions. Then we're going to go into some of the history of how elections matter. What do they really mean? Because the different roles we're voting for have different powers and obligations. So what does that look like? And then diving more so into the economic factors and wrapping up with the equity markets and everything else and how it all connects. So introducing myself, I'm Kenneth Hamilton. I'm born and raised here in San Antonio. Been in the industry going on 15 years. You might see my name with all the letters, the alphabet soup behind my name. Everybody on our team is a certified financial planner, which means we are fiduciaries, that we look at so much more than just in investments. We look at the whole picture, and then other credentials around income planning and social security planning. Uh, Matt, would you like me to introduce you, or would you like to give everybody an introduction to yourself?
I can introduce myself.
Okay.
So for those of you who know me, it's great to see you again. Those of you who don't, I'm Matt Donahue. I've got about 25 years of experience. Like Ken, the alphabet soup of credentials behind my name. Um, and it's great to be here. It's great to be here. Ben and Alan, I don't know if you guys want to take a moment to introduce yourselves, but they come from Kestra Investment Management, which is one of our primary investment partners, and they are part of that huge team that is got their hands on 10 and 2 with your investment portfolio every day. So Ben, if if you want to take it first and then hand it over to Alan, that'd be great.
Yeah, certainly. Well, I know I haven't met many of you on the call here. I work with Matt and Ken pretty intimately here. We're up in Austin, part of the Kesher Investment Management team. I've been in the industry for a little over 10 years now. And our team here is to eat, breathe investments all day, every day to make sure that our portfolios are where they need to be, and working for you guys. So I'll hand it off to Alan, who's the brains behind the operation. He's one of the portfolio managers who is making the decisions, coming up with the strategies, and again, one of those ones who has a true alphabet soup after his name.
Thank you very much, Ben. Yeah, my name is Alan John. I am the portfolio manager for Cashflow Investment Management team, and I'm mainly responsible for all the models that we have, and just sort of the due diligence on the investments, thinking about asset allocation, how to best construct a portfolio for clients based on the risk profiles.
Perfect. Thank you, gentlemen. Now, everybody on this call, this is a collaborative time. If you have questions for Ben, Alan, myself, or Matt, send it in the chat. We should have some time at the end to answer all of those things. And what you're seeing on the screen is our process. As a certified financial planner, we don't lead with the solution. We understand who we are, where we're trying to go, and through collaboration together with all the resources that we have at our fingertips, whether it's my expertise, Matt's, Alan's, Ben's, together for you, we put together a plan, and we constantly update and monitor it. That seventh step, well, it takes a minute to get to that seventh step, and many of you on this call are already there. But once we are there, we're able to tweak and adjust, look out on the horizon, see the clouds, and adjust the compass as we're going. But the process is where the majority of the benefit comes from, and y'all are on this journey, and thank you for being on it with us. But here we are, we're monitoring, we see clouds, we see things coming, and that's why we're talking today. And so when building a plan, we need to first focus on all the things that can go wrong. Some of you might be sports fans. You might remember the 6-second offense by Mike D'Antoni, with the Phoenix Suns. Again, they were putting up 150 points a game. But when it came time for the playoffs, when you got really familiar with the team, they were knocked out in the first, second round just about every single year by the Spurs, which was okay.
Ken's not a Spurs fan, by the way.
But offense is good. Investment returns are good, but more and more studies show it's preventing the down years. It's a prevent from making investment mistakes. And so a big part of that is risk management and having a steady stream of income coming throughout your retirement, whether it is your Social Security, your pensions, or different income streams that we can go discuss and help you find. But that's why we're here. Once we have that rock solid foundation, that's where the investments take on a higher priority role. So you can go on more vacations, help your grandkids with their college, and leave that legacy that you ultimately want to leave. But we can't put the cart before the horse. We have to prepare, have a foundation for all the things that can go wrong before we worry about the fun stuff. And today we're going to be talking about what are some of the things that might go wrong. And so does the election matter when it comes to your financial plan? Yes and no. You'll probably get that every time you sit down with us is, Ken, how does this work? Well, maybe. It depends. Right. Because there's nuance. And anybody that gives you a quick answer, as far as I'm concerned, you should probably run away. We provide thoughtful answers. So yes and no. So is it going to impact your finances? Maybe. But more importantly, what can we do to prepare to minimize some of those concerns? And let's decide together as a group, do elections really matter for the long term? Mr. Matt?
All right. So how elections matter. Couple things to think about here. There's a lot of stuff when it comes to politics and your civic duty and all those things. That's not what we're here to talk about today. Okay. We're not here to talk about any of that stuff. We're not here to say this party does this better than the other. That's not what we're here for. You can see a bunch of the political issues on this screen in front of you and some of the different federal logos, I guess, or whatever that go with that, right? And there are serious questions that politics will, hopefully answer, right? We might not always be happy with the answer, but at least, eventually we figure out a way forward. One of the big concerns, and there was an article this morning about this actually, is whomever is in control of Congress and the presidency in the next 4 years is going to have to start taking some actions on fiscal policy and the deficit. I'd love to hear Alan and Ben's commentary on this, but just as kind of an introduction, when you think about everything that's happened since COVID from a fiscal policy standpoint, there's really only 3 things the federal government or even a state government can do to help do things like keep inflation down. One is tighten monetary policy, make it, more expensive to lend, which is what the Fed did when they raised interest rates, right? Another thing that a federal government or a state government could do is actually cut back on spending. Because if they're not buying as much stuff, they're not competing with the private sector at that point for those goods and services. That helps draw inflation down a little quicker. That didn't happen at the state or the federal level, right? The third thing that could be done is actually raising taxes, right? Because that pulls more money out of circulation. That didn't happen either. So going into 2025, not even regardless of who wins, Ben and Alan, what's Kestrel Investment Management's take on, maybe not in the short run, but in the long run, how is this federal deficit and federal fiscal policy, how is that going to affect investors over the next few years?
Yeah, for sure. Happy to take on that. So it's interesting to see how sort of the election and the debate sort of unfolded, right? So at this time, we are not seeing, either party to be promising or talking about, policies that will result in anything that are, that will enlarge the budget deficits. And it's actually a fun fact that during the debates, right? So there has been no mention of deficit or federal debt at the Trump-Harris debate. So regardless of who wins, the deficit, we think, will be the loser, even without the extension of the tax cuts or the new spendings. So if we think about, a demographic, sweep, then that will likely result into sort of a rapid expansion of the spending programs, and the Republican sweep might result into, lower taxes. In both of the situations, we will likely to see increased deficits as marked by the orange bars, right? So we see a lower deficit compared to the prior 2 years, which will probably driven by, response to COVID. But it's unlikely that we are going to see a surplus there.
Okay. So what does that mean for the investor?
It's so we've been operating, as you can see in the blue bars, right? We've been operating in a deficit since really the 2000, right? But then the market hasn't really responded that much to it, right? It's something that is sort of a concern on a very, very, if you think about a really, really long time horizon. But as of now, we might need to raise the debt ceiling again in 2025 as a response to it. But other than that, we might see, just I guess a couple of more debt ceiling raises, but we don't really see significant impacts in terms of market responding to a deficit.
Okay, all right.
And so, Alan, while we could all agree, we all are, manage our household, and we believe a personal balanced budget, right? As a person, but as a country, and with modern monetary theory, did I say that right? Monetization theory, but nevertheless,
right, yeah.
With this deficit spending, as long as it's going into the economy, and for every dollar of deficit is adding $2 or $5 of GDP over the long term, that is one of the metrics that also matters, is what is those deficit dollars going to? Is that fair to say, Alan?
Yeah, that is fair to say. And also, United States is in this unique position, right? That dollar is very strong, and it is the reserve currency of the world, basically. And the Fed Reserve, there's a way for us to manage the deficits, right? So you can print, you can issue more bonds, you can print more money. So That is, yeah. And then again, going back to the modern monetary theory, as long as the deficits are driving GDP, driving the economy, and they're going to the right places, yes, that is not something to be very concerned about.
Okay. So, Matt, if we can go to the next slide. So the question is do elections matter for your financial plan and investment strategy? Well, in the short term, yes, elections can have a short-term influence on the markets, depending whether it's left, right, middle, up, down, whoever wins, there are probably some of the sectors that will benefit more than other sectors. One of the things that I've been learning and focusing with my personal growth and things I focus on is there's never a true solution. There's always trade-offs. There's trade-offs in everything you do. If I eat this, well, it doesn't taste as good, but it's healthier. Or I eat this, it tastes better, but it's not as healthy. There's a trade-off in everything. So no matter what happens, there is going to be a group that benefits, and there's going to be an area that maybe doesn't benefit as much. But this is where diversification comes in. This is why we strongly encourage you to have international, domestic, stocks, bonds, alternatives, assets that move in different ways. So wherever there is a pop, we're able to capture that, rebalance it, and keep it into the stockpile. But over the long term, election years, there's been increased volatility, really just due to the overall sentiment of the country. And we don't expect that to go anyway soon, but where there is volatility, as far as I'm concerned, comes opportunity. So it's about how we interact with those moments. There might be some increased volatility in 2020 in this year. A lot of the things I'm reading is we are not likely to have a guaranteed result or a result by this time next week. I hope we do one way or the other, but it might be a couple of days as they're wanting to count all the ballots in all the different jurisdictions and make sure it is what it's going to be. Now, as we talked about volatility, the last election that really rocked the markets was the 2016 election. The market had expected a Clinton victory. Granted, by 3 a.m. that morning, she had conceded. And yeah, the market went on a pretty bumpy ride. But the thing is it stabilized within a week, just in a couple of days. So with that being said, as long as we don't jump out and as long as we just ride the wave, you're going to be okay. And if you're on this call, you are already diversified. Over the last 2 years, we've already made moves to minimize and reduce some of the volatility exposure. We've already done all of these things to help improve your performance. So whatever's coming, it's okay. Now, if you're a friend of one of our clients, and maybe this is the first time hearing this, call us. We have a week. Let's jump in there before this volatility happens. I'm kidding. But that's what I have on that. Matt?
All right. So patterns to political regimes, are they a real thing? And so, folks, this goes all the way back to the 1920s. Okay, so this is the S&P 500 from January 1 of 26, okay, through September 30th of last year. And we've had a great, December 31st of last year. 2024 has been a fantastic year overall. And, 100 years is a long time. There's been a lot of presidents over the last 100 years. There's been a lot of changes of who controls Congress. What are some of the big issues that people are dealing with at any given period in time? And your $1,000 that you put away way back in January 1 of 1926 would only be worth about $14.6 million today if you had invested in the S&P 500 and just stayed the course, right? So you can see, right, when you look at the chart here, it's a pretty positive trend in any one direction. Alan and Ben, from a long-term investment standpoint, you see, like, there was a headline yesterday where someone's like, oh, we're going to have a lost decade in the next 10 years or whatever, but what do we see happening, right? From not just who's in office, but over the next, say, 4 to 8 years, 4 to 10 years, what do we see happening?
Yeah, I'll tackle the first part of that question, and it's a good question. As I used to be an advisor before I was in this role, and it was every election, whether one party or another is favored to win, you had the opposite party. Oh, the market's going to crash. Let me take out everything, and then vice versa. Next election comes in, and they say the same thing. And this chart shows is the market, no matter who's in office there, the market over the long run, which is what we try to focus on. I know Ken and Matt are really good at emphasizing that, is the market has good returns in the long run. A lot of the stuff that we're dealing with and with elections is more short-term noise there. That the one thing the market doesn't like is uncertainty. But as we have a president, as like same thing with Trump on that previous slide in 2016, when found out he was going to be the next president, the market took a humongous dip short term. By the end of the next week, it was back to where in positive from where it started the week before. And within that week, if you would have sold out and then bought back in, you could be costing yourselves 10% in a matter of a week. So a lot of that is short-term noise, but if you take a step back, which is hard to do because our news focuses on that, but if we take a step back and look at the long run over 100 years, or even if you take these shorter periods of 8, 10, 20 years, the market has positive returns, and that's the bigger thing to focus on instead of getting bogged down with the shorter term noise.
Thank you. Alan, any thoughts on the next few years, regardless of who wins?
Yeah, for sure. So I do want to quickly address, the chart that we're looking at right now before I get into the forecast for the next few years, right? So, overall, on average, election year stock return was 8%. And non-election year, the average was slightly lower at like 7.6, 7.7%. So this year to date, we are already up. S&P 500 is up like 23, 24%. So we are already way above the curve. It's an atypical, it's not a typical election year sort of stock return. And then kind of putting that into perspective, we also need to sort of take a step back and think about I like to think about like the three different realities, right? The one reality is what your news cycle, what your TV is telling you, whether Republican or Democrat, how the economy is doing. And another reality is how the economy is actually doing. And third, the market performance is also not like 100% tied to the economy. Like the average person might have felt, inflation skyrocketed in the past few years. They may experience difficulty finding jobs, and then they will think the economy was not good. But if you look at the stock market performance, year to date 2024, we are up like 23, 24%. So this is something that we need to sort of take into perspective, right? Kind of the news cycle might be feeding you information, telling you that the economy is terrible or the economy is doing great, but we need to differentiate that from, how the stock market is actually doing. And then going back to what Matt brought up, which is, a lost decade. This is, I think, came out of Goldman Sachs, and they were arguing that, in the next 10 years, U.S. equity return will be like, 2 to 3% range, right? So this is a part of what they call capital market assumption process that they do. They try to estimate different market returns in the next like 5 to 10 years. And I've been in that position before in my prior role. And usually the way that they do it, valuation is a big component of that. So valuation meaning just relatively speaking, how expensive or cheap U.S. stocks are compared to the rest of the regions, right? And also compared to its history. So if we draw those comparisons, the U.S. market is at a relatively expensive position. So it's on a relative basis more expensive than international, more expensive than emerging markets. So that will drive a lot of those kind of lower return that we see coming out of these Wall Street firms. But another thing to consider is really the earnings, right? So valuation is only a piece of the puzzle. The earnings potential, the earnings capabilities of the U.S. corporations are still, in our opinion, strong and relatively speaking, stronger than international companies or emerging market companies. So even though we see these estimates, like I've lived in that position, like small changes in the assumptions will change the numbers by a lot. So we might not need to like focus too much on the headline, lost decades or like 3% average return in the next 10 years, because like I could build the same model and then, just by changing one or two numbers, give you like a 5% or 6% return, which will be like average, across the board. So stock on average, S&P 500, we got these data from Professor Siegel going back to like the 1920th. On average, stock return 8%, adjusting for inflation, kind of across the board during this period of time. So if you look at really like kind of a long-term horizon, right, even though the U.S. market might be a little bit more expensive, like the prudent thing to do is to diversify, right? Maybe it's expensive, but we don't want to completely sell out of the U.S. market. We may be able to sort of adjust the weight of the U.S. market, become a little bit less overweight U.S., and allocate a bit more to international emerging markets, but still keep invested because you want to, ride that stock return of 8% a year in the last 100 years, basically.
And I think that's the key there, right, Alan, is staying invested. Because, if you're trying to time the market because you think, oh, this is going to happen, I wish I had your crystal ball because you don't know. And Ken talked about that in his introduction, right? I mean, we think things are going to go a certain way, and then they never go exactly the way that we thought they were going to go. That never happens, right? So if you're going to jump out, okay, but do it for a reason. Not just because you're nervous, not just because the market took a dip, but hey, I had to get out of the market because I actually retired and I needed to transition my growth portfolio to an income portfolio. That's why I changed my investment strategy. That makes sense, right? But if you're jumping out just because of a news headline, or if you're jumping out back in 2016 because, the market thought A was going to happen from a presidential election standpoint, and then B happened, that's not the right move. That's not the right move at all. I've had a lot of people ask me this over the last few months, and this is something I firmly believe in. Equity markets tend to like gridlock and nobody else does, right? But equity markets do. And I'll turn it over to Ben and Alan to talk about this a little more. But if you can take a look at the right-hand side of your screen, you'll see that 3 of the 5 best performing periods are when you've either got a split or some kind of combination between Democrats and Republicans, right? 15, 16, 16%. My 2 cents on that is literally that it lends a bit of predictability for that election cycle. Because if neither party's in full control, neither party can steer hard one direction or the other and maybe have a ripple effect on what's going on in the market. That's Matt Donohue's 2 cents. Alan and Ben, it'd be great to hear what you guys think about that.
Yeah, for sure. I think this chart is fascinating. We will also, when we were looking at election years, we were also doing the same thing, right? Looking at Democratic president versus Republican president, and also how the Senate and the Congress, how they're divided and all that. And I think the messaging is spot on, right? Gridlock is looking at the charts here, 15% if it's a Republican president with the splits, Congress and Democratic, president 16%. One thing to note here is that it did exclude the year 2008 with the global financial crisis. And if we added that back in, then that might change the numbers a little bit. But it's still, 10.7%, still a good number compared to the historical averages. So overall, I think the messaging here is looking at across the board, like none of these are bad numbers per se, right? Even like Republican and Democratic, it's like 9% annual return average, which is still like on par or slightly higher than the historical average. So going back to the previous point that Matt made, right? The election results and sort of what's happening with the political regimes, sometimes they don't have like really high correlation or impact to how the market performed. They will have some impacts in like specific sectors, right? If you publish, let's say like a policy that is really favorable towards energy, then of course the energy stocks would, sort of respond to that. Or the market expectation would be, that energy might go up leading up to that point. But overall, right, if you look at the entire market, the correlation there is limited.
Yeah, and I think that's the key. Ben, I don't know if you want to comment on that, but just the limited correlation.
Yeah, and I think that's what we were talking about there is just staying invested over the longer time is even in, you know, the worst number on here is still 9%. You know,
Right.
if you were to sit here and say you're going to get 9%, I would take that all day. Obviously, when there's a split, I think it's kind of the same thing I was alluding to earlier when the market doesn't like uncertainty. So when you have that split, you know that there's going to be hopefully collaboration between the two parties to get things done, because at the end of the day, we all want to make money. We all want things to progress, you know, with the market and the economy. And at the end of the day, having kind of the split and two different or multiple different philosophies there can help, as we see in this chart, returns have been better when it has been split. But overall, like said, is not a bad number on here over the long run.
Right. Yeah, and that's the key, right? Is they compromise has to happen when there's a split. So Ken, we're in the last few minutes of the actual presentation here, then we'll open it up for questions. Take us home.
Sure. So moral of the story, everybody, global macroeconomics are not the microeconomics of your household. What you have going on, what we have put in place, yes, they inform one another, but they shouldn't dictate one another. It's all about understanding the time frames, and we have this conversation on a regular basis. What is happening in the next 2 to 5 years? Where are those dollars going to come from? Taxable account, tax deferred accounts, or tax-free accounts? What makes the most sense? The money that you're not needing for 10 years or 15 years from now, how are those to be invested? I mean, we've seen a lot of movement over the last 2 years with interest rates and how they've changed. Yeah, those are the things that will change, not even change, course correct, right? Because going back to that maintenance, the financial planning wheel of how we get you there, we're still headed north, but making some short-term changes, which we're doing all the time for you, isn't really going to change our long-term plans, and you're going to be okay. And it is nice and refreshing to look into presidential elections and what all this means. But at the end of the day, you're going to be okay. The investments are going to perform. We have a plan, and as long as we take that long-term approach, we stick with it. And again, many of y'all, we've done this over the last couple of years. When interest rates or when the curve first inverted back in 2019, there were things that we put in place that we took advantage of. When the stock and bond market were down double digits last October, there are things we were doing for y'all to take advantage of that. So remember, even though there might be volatility in the coming weeks and months, all it is that there's going to be options for us to make good, informed choices for your plan that will improve the long term. We always make sure we have those short-term buckets, and we're going to make the most money by making those moves for the long-term buckets. Matt, I think that's just about it.
That is it. So stay invested, right? Don't, I tell this to my kids all the time. Don't get too excited. Don't get too depressed based on what's going on next week, right? Stick to your plan. Stick to your plan. And that's the whole value of planning, right? Is when the unexpected happens, you've got some ideas about what you can do. And that's the key. That's the key. Don't get too high. Don't get too low. Stick to your plan. Ken, what kind of questions have popped in at this point?
Very few to this moment. So just kind of shooting from the hip, would a tariff, what kind of would a tariff economic policy have on the stock market in your view, Alan?
Yeah, that is something that's we're actively discussing. I think it's I wish it's only a thought experiment, but it might not be the case. In terms of the market performance, right? So I think there are several pieces. One is that so there has been some talking about, Trump raising the tariffs, and more specifically towards China. And that will be, I've heard numbers like 60% or some, some other numbers. One piece is that how would, the receiving party of the tariffs, could be China, could be other countries, respond to the tariffs, right? There's several potential outcomes. One is that they start to do a lot of domestic stimulus as well to sort of adjust for this new geopolitical environment. And the second is that they might retaliate. And how will they retaliate, right? That could hit different corners of the market. Like one thing is, again, using China as an example, like what are some of the things that China buy the most from the United States, right? They buy a lot of agriculture products. They buy a lot of, airplanes, right? Heavy industrials. They also buy a lot of chips. And the chips has been sort of, impacted recently, just given the policies, the semiconductor rule. But those are the potential sectors that could be hit back by China, or by, the situation differs if it's the European Union or the Mexico, the other countries, right? And the second part of consideration is that tariffs, right? Many would argue that even though it does bring sort of revenues, in the form of tariffs to the U.S. government, it might also lead to inflation, because you are no longer enjoying sort of the global distribution of labor, right? Like a lot of the products from China would be, if you compare, similar quality products, will be cheaper if they were produced in other places due to like the labor cost being lower, or that they just have sort of a more complete industrial complex. So that's something that need to be sort of taking into consideration as well, the potential inflation uptick. And with inflation rising up could lead to Federal Reserve changing the policy, then changing the market. So I kind of talked a lot about what could potentially happen, because it's a very complex situation and there are many moving factors. I think the worst case scenario is, let me put it simply, is that higher tariffs leads to higher inflation. And then that forces Federal Reserve to sort of reverse the action that they did, right? They've been dropping, they are targeting lower, interest rates because the inflation is under control, economy, is doing okay. If inflation ticks up again, they might need to pause the decrease, and then they might need to, hike again. So that will have significant impact on the markets, and it's not going to be pretty.
Okay, so in summary, interest rates are kind of one of the more impactful bellwether of the direction of the economy, at least in the short term. Is that fair to say, Alan?
Yes, in the short term, it's a lot about the Feds.
Okay, Mr. Ben, why don't you bring us home with some closing thoughts?
Yeah, I think we talked a lot about in this, back to my advisor days too, I'd emphasize the same things that Matt and Ken talk about, which is diversification, taking a step back and looking at the longer term picture. It's so easy. I'm guilty of it myself, and I'm sure everybody on this call, you get wrapped up in headlines, kind of start doom scrolling, and then you think the world is ending. But we've gone through, you look at the last 20 years, all the stuff that this country and the world has gone through. You had the mortgage, the banking crisis in 2008. We had COVID, everything in between there that are small stories now, but it's just noise in the short term. And the one thing that all these charts show, if you Google anybody who's done research on it, is stocks in the long run, staying invested, not trying to time the market, because I always like to tell people that's two decisions you have to make, is when to sell out and when to buy back in. And I know during COVID, the time to buy back in, I know this because it was a week after my wedding, the market was at its lowest, and that was when everything looked the darkest. Everything was closed, but that would have been the time to buy in. So it's really two decisions you always have to make, where if you just stayed invested, some people just intentionally logged out of their accounts, forgot their password, and we're in a much better position than those people trying to time and pick and choose, because they ended up trying to chase and then kept doubling down on these decisions. And it's a dangerous game to play, where you can sit back and relax and look at the longer term picture. And I know Matt and Ken do a great job of that.
So you heard it from Ben. Everybody go ahead, delete your password managers, stop logging out. Direct words quoted from Kestra Investment Management. There we go. All right. Thank you, everybody. Thank you for you taking time out. I know it's been a long election cycle. We're here at the home stretch. Thanks for all your time, your energy, being here during your lunch hour. If you have any questions, call us. That's why we're here. Let's schedule an one of our annual reviews. There, you should be receiving in the mail one of the end of year checklists. There's definitely something that we could be talking about, if not to get done this year, to launch 2025 into a very successful year, just like this one has for everybody. Thank you so much. Matt, any last words?
Nope. Thank you, everyone. Go vote. Go to bed early on next Tuesday. Wake up in the morning, and guess what? The sun is still going to come up. Just
Alrighty.
is. So.
All right.
All right.
Take
Thanks,
care.
everyone.
Thanks, Alan. Thanks, Ben.
Thanks, guys. Bye.